Hello everyone, welcome to Sunny Sir classes. Important topic that we would discuss today for CFA exam is asset allocation. This topic would be more useful for students who are planning to appear for level 3 exam. Let us understand what is asset and what is allocation. What do you think asset is? Anything that you own, anything that helps you in generating more and more income. What is allocation? It is nothing but distribution. If you have $1 with you, how much money would you invest into different asset classes? Or let me take a different example. Let's say you have $100 with you, and I ask you to invest this money on my behalf. So what financial decision would you take? You might invest in equities, you might want to invest in fixed income bonds, you might want to invest in real estate, private equities, different asset classes. All these or all the major asset classes are visible on your screen. But how would you really make this decision whether it should be $20 into equities or $50 into fixed income or $30 into alternative investments? It's a very difficult call and depends on what type of client do you have. So after completing your CFA, a lot of people or a lot of you would be working in investment consulting field, wherein you would be working as an advisors for your clients. You would be telling them how they should invest their money or how their portfolio should look like. Moving on to the next slide. So here you would see there can be three different types of investors. There could be aggressive investors, there could be moderate or conservative investors. Now, what are aggressive investors? Young people or people who have a lot of money with them, people who come from sound financial background, who have high risk appetite, and who have at least 10 to 15 years into their retirement. Now, what are these moderate investors? People who are very near to retirement, but still not into retirement. And now, what are these conservative investors? People who have already retired and do not have any other source of income. So, how their portfolio should look like. So, if you would look at the first pie chart, you'll see the red block is 50%, which is nothing but stocks. That means an aggressive investor would like to invest huge amount of money into stocks and less into alternative investment and less into bonds as well. Same ways, a moderate investor would have 30% into equities. This range can differ, but if you will compare the pie chart for aggressive investor and moderate investor, then you would see that investment into equities is high for an aggressive investor, whereas it is a bit less for a moderate investor. Same ways, if you look at the equities investment for conservative investor, it's pretty less as compared to what moderate and aggressive investors have invested, right? So the cash allocation is quite high for this conservative investor. So accordingly, a lot of client would come to you and would ask you or request you to make their portfolio. So it depends on how you really look at the type of investor, whether it's an aggressive investor, moderate or conservative investor, and depending on that, you would advise them that where they should be investing their equities, where they should be investing their money, whether it should be high on equities or high on alternatives or high into fixed income. Again, this particular chart that you are looking on the screen is very much similar to what we have just discussed. So if you'll see, the investor who is into early 20s or 30s would take more risk, whereas a person who is into 60s or maybe into 50s is not taking very high risk. So the proportion of fixed income would increase as you grow. So for a person who is 20 years old would be investing high into equities. For a person who is 70 would invest high into fixed income. Now, what are the major factors that you should look at before constructing a portfolio? So there is a very common terminology that I read, which is RRTTLLU. Now, what exactly is this? So if you'll see, R stands for risk, the second R stands for return, then it's tax, time horizon, legal restrictions, liquidity, and unique circumstances. Now it depends on each individual how much risk is he ready to take. A person who is looking for high returns would obviously want to invest into risky assets like equities, whereas a person who is satisfied with nominal or normal returns would not want to invest high into equities. So you need to check the trade-off between risk and return. Again, if a client comes to you and says that he does not he wants only tax-free income, then obviously you would look at some instruments wherein the tax rate is not very high. And same ways, you would also want to check with your clients that for how long or what should be the duration of the investment. There would be people who would say, I do not want to invest for more than 3 years or 4 years. At the same time, there would be investors who would say that I really want to invest for 10 years, 15 years, or 20 years. So obviously, you'll need to consider what the time horizon is. Same ways, you would check if there are any legal restrictions, if you have to invest in certain geography. Maybe if I live in developed world and I want to invest in emerging markets, I would look at what legal restrictions are in those geographies. Same ways, liquidity. If I invest in real estate, let's say I purchase a building, it would be very difficult for me to sell that building, right? Because liquidity is not very high. Whereas if I invest in equities or fixed income, then the liquidity is certainly high as compared to investing in real estate. Then there could be some unique circumstances. Obviously, there could be some investors who would say, okay, let's say I do not want to invest in alcohol stocks or liquor stocks, or I do not want to in tobacco companies. So these are some of the unique circumstances that you need to look at. I really hope you like the session. Thanks and all the best for your exam. Thank you very much.